everyone, and welcome to your daily market briefing. Today we're looking at a market that is just walking a fascinating tightrope. On one side, you have warships and some serious tension building in the Persian Gulf. And on the other, well, stocks are absolutely surging. Let's break down what is going on here.
I think the perfect theme for today is this: risk on with a side of caution. We are absolutely seeing a return to risk appetite, no doubt about it. But it's all happening against a backdrop of some pretty significant geopolitical drama. It's a classic tug of war, and we're going to figure out who's pulling harder. So let's start with those tensions on the geopolitical chessboard, because honestly, the signals we're getting are all over the place, and they are without a doubt the main thing setting the tone for global markets right now. Okay, first, the major escalation. After those talks mediated by Pakistan fell apart, the U.S. has gone ahead and imposed a full naval blockade on Iranian ports. Now, this is a serious move. It kind of takes diplomacy off the table for a minute and puts warships front and center. And yet, literally in the next breath, we get this. President Trump starts hinting at an amazing deal that could happen in the next couple of days. He says he'd rather have a negotiated end to all this. So what is it? Is this just brinkmanship, or is there a real path to de-escalation? The markets are hanging on every single word. And you have to remember, this is not just a two-player game between the US and Iran. I mean, look at the wider board. China and Russia are pushing back, which got Beijing labeled an unreliable partner by the US. Meanwhile, the UK is sending a huge drone package to Ukraine, and Israeli strikes on Hezbollah are still happening. It's an incredibly complex web, and every single move sends ripples everywhere. Now, with all this uncertainty swirling around, you would expect markets to be running for cover, right? But they're not. Actually, it looks like they're rallying on pure hope, choosing to ignore the storm clouds. For now, anyway. Let's take a look at how the world is reacting. So, U.S. stocks are just pushing to record highs, completely ignoring the risks. Oil is caught in that tug of war we talked about, just hovering above $94, torn between peace talks and a real-life naval blockade. The dollar, it's kind of drifting sideways, not sure what to do. But gold? Gold is loving the confusion, climbing right back over $4,800 an ounce. And this risk-on feeling wasn't just in the U.S. Let's turn our attention to India, which saw a pretty stunning reversal. After a really sharp sell-off on Monday, the market just came roaring back. I mean, just look at these numbers. The Nifty and Sensex both shot up over 1.6%. But what's really telling here is the outperformance from the mid and small caps. They rallied over 2%. That is a classic sign that investors' appetite for risk is firmly back on the menu. Okay, so let's look past the big rally for a second and dig into India's hard economic data, which, well, it's telling a much more complicated story. And the first piece of data is definitely a red flag for inflation. Wholesale prices jumped 3.88%, which is the fastest increase we've seen in over a year. It's a good reminder that even when the market is rallying, these underlying price pressures are still a major concern for the economy. But to balance out that inflation worry, we got some incredibly welcome news on the trade front. The trade deficit narrowed, and narrowed sharply, coming in at $20.67 billion. This is a huge positive data point that definitely helped prop up that market sentiment. So how would the trade balance get so much better? It's actually pretty simple. Stronger exports and weaker imports. It's a great sign, but, and this is a huge but, the tensions in the Persian Gulf could mess with shipping lanes at any moment, and that could erase all this good news in a heartbeat. All right, let's zoom in from the big picture and get tactical with the charts. For all you traders out there, these are the key levels you need to be watching across some major currencies and indices today. So first up is the DXY, the US dollar index. It's been drifting down, especially after new data showed producer price inflation was a little weaker than expected. That gives the Federal Reserve some breathing room, less pressure to keep rates high. And for traders, it's made selling on the rise a pretty winning strategy lately. So the strategy here remains selling into any strength. We're looking at an upper limit or resistance right around 98.17. And if the dollar does fall, we're watching for a floor or support at 97.53. Today, all eyes are going to be on jobless claims and the Philly Fed Manufacturing Index to see if the U.S. economy is showing any new cracks. Now, let's hop over to the euro. It's basically been trading in a pretty tight range around that 1.1800 level. So far, buying the euro whenever it's had a small dip has worked out pretty well. The big market movers today are definitely going to be the latest inflation data, the CPI, and of course, any comments from European central bank officials. So the approach here is to buy on dips. The key support level to watch is 1.1780 with resistance up at 1.1835. But the really critical number on the chart is the weekly pivot point at 1.1876. If the euro can break decisively above that level, it could really signal a much bigger move to the upside. Next up, the British pound, which traders often call cable. A little fun fact, that's a throwback to when the exchange rate was literally transmitted through a transatlantic cable. Right now, it's consolidating near 1.3558. The strategy is to buy on dips, but you've got to be careful. The UK economy is facing some real headwinds, and we have a ton of UK data coming out today.
So keep an eye on resistance at 1.3638 and support way down at 1.3450. The direction from here is almost certainly going to be decided by today's reports on GDP, industrial production, and trade. Traders are just desperate for any sign of sustained growth from the UK. All right, let's look at the Indian rupee. It stayed mostly flat, really caught in a tug of war. On one side, you have the comfort of lower oil prices, but on the other, there's really strong dollar demand from importers. The structure here is still a buy on dips, but what's really interesting is that there's just no momentum behind it. So while traders might be looking for a good entry point, there's not a lot of conviction. For now, key resistance levels are at 93.40 and 93.66, with supports down at 93.19 and 92.90. And finally, let's circle back to the Nifty. As we saw, it rallied hard, really driven by those lower oil prices and the rising hopes for US-Iran peace talks. This made the buy on dips approach super effective yesterday. So, on the downside, we're looking for support around the 24,172 and 24,033 levels. To the upside, resistance is sitting near 24,280 and 24,399. But the real battleground, the key level to watch, is the weekly pivot at 24,429. A strong move above that could trigger another big leg up for the market, assuming, of course, that geopolitics doesn't throw another curveball. And that brings us to what's on the radar next. Because all this hope we're seeing in the market could be tested, and tested very quickly, by a packed global data calendar. Just look at this lineup. We're getting a full economic health check from China. Then over to Europe, we've got key inflation prints. The UK reports its GDP and trade data. And then the US rounds it all out with jobless claims and the Philly Fed index. There is some serious potential for volatility today. And this really frames the central tension we're facing perfectly. Right now, markets are buying the rumor of peace, the rumor of diplomacy. The million-dollar question is, will they be forced to sell the hard facts of today's economic data? We will definitely be watching closely.